Hello, everyone, and welcome to the presentation today. We're delighted to have you with us, and as we delve into today's important topic, private insurance. For those of you that don't know me, I'm the owner of Legacy Tax and Resolution Services. I'm a certified public accountant, a certified tax resolution specialist. I have a JSM in U.S. and International Tax Law from the Thomas Jefferson School of Law. I'm also an NTPI Fellow with the National Tax Professional Institute. As a firm, we help high net worth clients with strategic tax planning and tax recovery. Our first speaker today is Craig Clemens. He brings a wealth of experience and insight. Craig has a Fortune 500 background as a seasoned C-suite executive and leads business development and private insurance platforms in more than 30 markets. His extensive background in sales and marketing and leadership and his commitment to financial and risk management education make him an ideal guide for today's topic. Joining also is David Auer, the founder of Provident CPAs and Physicians Tax Solutions. With over 35 years of experience as a CPA, speaker, author, and consultant, David is recognized for his expertise in tax financial planning. He holds multiple advanced degrees, including an LLM in taxation from NYU and several professional designations. David's insight into tax and financial strategies will be invaluable to us. We also have John Auer, the client service manager with Alliance Reinsurance Company. Together, they've partnered to establish Alliance Reinsurance Company. We're excited to guide you through this session and provide invaluable insight into private insurance strategies. Now, I've got to provide a disclaimer to you. This information is general and may not apply to individual situations. Captive insurance and alternative risk planning involves complex legal, tax, and financial considerations, requiring professional guidance. This presentation is not formal legal, tax, or financial advice. So let's go through the agenda for today. We're going to start off by what is a private insurance company. Well, then we'll look at the history of private insurance companies. Next, we'll explore why create a private insurance company. Then we'll discuss the types of insurable risks. We'll go through some actuarial assessment samples and discuss the benefit of a private insurance or reinsurance company. After that, we'll break down the ideal structure of a reinsurance company. And then finally, we'll introduce what I call the tax unicorn, the 3R plan. Then we'll open the floor to Q&A, and finally, we'll wrap up with the next steps. And now I'll turn it over to Craig to start the presentation.
Stefan, thank you very much. That's a great tee up. I'm excited to get rolling and tee up what we know as private insurance company. It's also known as reinsurance. Some call it a captive and micro-captive. David's going to get into what separates some of those nomenclatures. But really, private insurance has been around since the 1600s. It really is about a company self-insuring their risk. So if you look at that second point there, the company, the business leader, enjoys risk mitigation. Why? Because he's turned on private insurance. One of the outcomes of that is that business leader gets to enjoy the underwriting profits because he owns a commercial insurance company. So other than giving all that premium to State Farm or Geico or Progressive, now he's part of a insurance company and can reap some of those benefits. So that's really what that is. I mentioned 1600s. If you go back to the days of Moby Dick, ships went out and did what? Went on whale hunts. And they were underinsured because the original 13 colonies were fueled and lit by what? Whale oil. Well, believe it or not, a coffee house said, hey, you guys are underinsured. We will pool monies and we will allow private insurance to take place on your excursions. Interesting, right? Then jump to the 1800s where the Industrial Revolution blew up. Why? Because of the steam engine. The steam engine, for instance, on the textile industry had a 500x improvement. We went from little old ladies tailoring suits to a steam engine, but steam engines had what? Fires. So believe it or not, a church comes along and says, we'll help insure you. We'll provide private insurance to all your textiles. So people that enjoyed private insurance back in that period, the American Industrial Revolution, were Henry Ford and Andrew Carnegie with steel, and the Rothschilds with textiles. If you're a history buff like me, I find this pretty fascinating. Then jump to the 50s, 60s, and 70s. That's when everybody was parking an insurance company offshore. Think about Bermuda, Jamaica, Cayman Islands, Nevis. Um, so, think about people like Mitt Romney. They've all stood these up in that period offshore, and we're not doing that. We actually are domestically domiciled in our model. So is it popular? Yes. Today, the assets of reinsurance or private insurance, it's doubled since 2013. And in the US, it represents, I believe, 200 billion is the next bullet point that comes along. Yep, $200 billion in 2023. And it should reach 630 billion by 2034. That's the US. Globally, the assets of reinsurance are 800 billion. And we'll see $1 trillion in assets of reinsurance in our lifetime. So is it big? Yes. And is it growing in double digit? Yes. 92% of Fortune 500s use some form of private insurance. About that same percentage of automobile dealers use reinsurance for extended warranty. So, Stefan, if you go down to Phoenix and buy a Ford F-150 truck, they're always pushing that extended warranty, right? Why? Because that dealer is carrying that risk of that warranty when you roll off that lot. If there are no claims in that 2-year window, that $2,000 of extended warranty goes to his left pocket as underwriting profit. So that's why they're always pushing extended warranties. The dealer is carrying that risk. He's using private insurance across all of his cars on that lot. Of course, we know that Ronald Reagan got involved. He was probably before Trump the last great, small business advocate. In his second term in 1986, he dropped private insurance formally into the tax code under his legacy legislation called the Tax Reform Act. And then, of course, the IRS recognizes private insurance as filling in the gaps. Yes, it's legal and compliant to all business leaders in all 50 states. I love this slide. This guy is worth $150 billion. He's the 8th wealthiest man in the US behind, I guess, Elon and Gates and others. He owns Geico, right? Berkshire Hathaway owns Geico. And he also owns a private insurance company called General Reinsurance. We call that Gen Re in the marketplace. Well, guys, he has stacked up 150 billion in premium. So the American taxpayer signs up for Geico, pays premium. That's stacked up under Warren Buffett's insurance companies. When you hear of him buying stock at NASDAQ, he's using what? Premium. So if he buys Coca-Cola or McDonald's or Apple or Amazon, he's using tax advantage premium to make those purchases of stock at NASDAQ. Your clients can do the same thing. We can define their risk. That risk becomes a policy. They punch premium into the structure we're about to show you, and they can have a custodian and make stock investments out of what? Tax advantage premium, just like Warren Buffett.
Yeah, and as a matter of fact, they have a fiduciary responsibility to prudently invest that money.
Correct. Thank you, Stefan. Exactly. What industries are good for private insurance? Well, any business with risk, which is what? Every business. So we are legal in 50 states. We serve right now business leaders in 30 states, 30 US states. And these are some of the represented industries, everything from cannabis to retail, to restaurants and hospitality, to trucking and transportation, to home building, to commercial construction, to, of course, professional services like pediatricians and neurosurgeons and orthopedic doctors, lawyers, engineers, people in aviation and aerospace. So really everybody in your portfolio of clients can use this tool.
I mean, in cannabis especially so, because unfortunately, cannabis is still kind of hands off. So a lot of insurance companies won't touch them.
But if you have a private insurance vehicle, now you can push money into that by way of premium. That's exactly right, Stefan. The four motivating factors of using private insurance, well, control risk. I mean, this is an insurance product and you're mitigating risk. You minimize your P&C insurance costs. So once you stand this up, it's very popular to go back to your State Farm or Geico or Progressive or USAA and raise your deductible and lower your premiums. So now you're balancing and blending the cost of your risk coverage. Improve cash flow, yes, and you improve your cash flow. And David likes this one, wealth accumulation. You're building wealth with what? Tax advantage premium. We built this slide for JP Morgan in a continuing education webinar. It points out that you're not going to turn off your P&C, at least not initially. Let's say that you're using State Farm. Well, with them, you're covering automobile, GL, and workers' comp, etc. But when we stand up private insurance, an actuary is going to come in and look at your businesses, not just one, but all of them, risk exposures. And what we find across the spectrum of industries, they look like this: loss of key talent, reputational risk, brand risk, right? State Farm doesn't cover your reputational and brand risk, regulatory risk, legal risk, business interruption like COVID, DNO, ENO. So when we go and do an actuarial assessment, 10 to 20 line items of risk come back in that report, and it reflects many of these line item risks we're looking at here. Let's look at healthcare. David, 85% of your clients under your CPA firm are affiliated in healthcare and medicine. So this is a healthcare professional doing 1.2 million top line revenue. A through K over there on the left represents what? His underinsured risk. So now we take that data and we form a policy around that. He can now punch in 1.89, almost $200,000 as premium off his P&L. So that's an expense off his P&L, lowering his tax burden, and that money comes over the fence as premium. Here's another healthcare professional. He has, I don't know, 7 or 8 line items of risk there on the left. Those are his underinsured risk on top of his P&C coverage and his medical malpractice. This gentleman's doing 5.5 million. Well, there's that 10% again. He can punch about 10%, $580,000 annually as remitted premium. Here's another healthcare professional with about 10 line items of risk. This is a pretty significant player doing $14 million in pain management. I believe he has several clinics, not just one. And he's just under the 10% threshold. Let's call that 1.2 million, middle of the page. So 1.2 million is coming off his books, off his P&L every year as a business expense, which is insurance premium. Last one, dentistry. So this particular dentist probably has several offices, because I see he's doing $8 million lower into the page. That's his underinsured risk on the left, A through Q, identified and validated by a third-party actuary. No one on this call. This is a commissioned third-party actuary identifying those risks. Well, in this scenario, this guy's a little bit of the 10%. He can punch $1 million off his P&L as remitted premium. Okay.
Guys, you got to understand this. That's $1 million coming right off the top, reducing taxable income by $1 million.
David, let me hand this off to you because you do a better job than me talking about the traditional insurance companies versus what some would call a micro captive, and what are the differences between the two?
Great. Thanks, Craig. So welcome, everyone. Yeah, just back to on a couple of those case studies, what I've found, practically speaking, with a lot of our clients, especially those who have, a fairly significant amount of net income that is above what they need to live on, this just gives them a perfect opportunity to skim all of that additional discretionary cash flow right off the top into something that is, is tax deductible. And then, as I'm going to talk about here in a little bit, how potentially it can turn into future tax-free wealth. So just real briefly, at a high level, the difference between, from a tax standpoint, there's two general types of private insurance company. One is the traditional type of private insurance company that is governed by Internal Revenue Code Section 831A. Another type that has become popular since 1986 is the micro captive insurance company. That's governed by Internal Revenue Code Section 831B. And then in either case, basically, the premium going into that that insurance company is tax deductible. If it's insuring business risk, if it's a real estate investor that would otherwise like to maximize their write-offs, then they might have additional deduction, but it would be against their net rental income. So there's a couple of different ways, depending on the type of business and what type of risk. But in either case, it is a fully deductible expense under Section 162. The premium, how the premium is received by each company is taxed differently. In a traditional private insurance company, the net earned premium, which is a number based on a certain type of accounting method to spread that income out over a period of time. In a traditional insurance company, small parts of that premium as it earned is recognized as taxable income. In a micro captive, it is not taxed as income, which is also why that micro captives are very popular. Dividends that come out of the company in either case are going to be subject to long-term capital gains. But one of the biggest differences is going to be in how the IRS looks at these. So over the last 20 to 30 years, there's been a significant number of businesses that have gone down the path of a micro captive. And as you can typically predict, and when something looks really attractive, you're gonna attract a lot of people who either abuse situations, or they just don't do it properly, or they get too greedy. They try to go inflate the amount of premium that they're going to pay into their company, which generally the IRS is going to scrutinize. So these have been micro captives have been under the even though they're statutorily if they're set up properly, there's no risk that of an IRS audit resulting in a taxable income amount, but it is something that draws attention from the IRS. In the traditional private insurance company, it is not on the radar screen. Traditional private insurance companies are generally what all of the Fortune 500 companies are established. And the reason for that is because there's an overall income limitation when you set up a micro captive. Currently, it's $2.85 million. That gets adjusted every couple of years. And then the other big difference is that generally there's going to be, depending on which companies you talk to, are going to have relatively high amounts of revenue that a business is going to have before they'll even talk to you about potentially setting one of these up, which is what we found to be one of the biggest limitations with our clients in the CPA firm is we, our top 5 or 10% of our client base who had significant revenues, setting up a private insurance company has for 35 years been, one of their favorite tax strategies. But everybody, the other 90% that otherwise have significant amount of income and cash flow, they couldn't find a company that would work with them. And that is up until the time that Craig and I met this last year, and that's what created the opportunity to have this webinar today. So just generally speaking, the way a micro captive insurance company is set up, and it depends on which jurisdiction you set it up, there's a requirement that you capitalize that insurance company. That ranges anywhere from $200,000 to $1 million. That's just to make sure that the regulatory agency overseeing that private insurance company has enough capital to meet claims. Ownership of a micro captive has to mirror exactly what the operating business ownership is. So, for example, if you have a husband and wife that own the operating business and they want to set up a private insurance company, the husband and wife are going to have to own the private insurance company. There is no opportunity, unlike the one that I'm going to mention here in a few slides, where you can use this as a wealth transfer vehicle to the next generation. In this case, with a micro captive, you can't do that other than just give that company to your heirs at the end of your lifetime. Setup fees are generally fairly high. There's usually a generally high fixed value or cost, anywhere from 75,000 or more to set one up, and then close to about half of that every year. But on average, it's about 32% just of what comes off the top of the premium to cover the costs associated with the micro captive. One of the other issues hurdles you have to get over is that all of the micro captives are going to be, if you set them up under a particular state's laws, they're going to be regulated by that state's insurance department. They are subject to regular and ongoing examinations and audits. Every time you make an investment, you need to get approval. And then the way that the incentive for the state to try to attract businesses to form private or micro captives in their state is they don't have an income tax on a micro captive, but they charge what's called a premium tax. So it's in lieu of an income tax. So a percentage of that every dollar is also going in the form of premium. So when you add that to the administrative costs, you're looking at a pretty significant haircut of every premium. And with all that said, they're still pretty popular. And then the other issue that you have to deal with a micro captive is generally you're going to be sharing risks with other business owners, meaning that if you don't file a claim, but another business does, then part of the premium that you paid in is going to go to claim or pay the claim of the other business owner when that claim is filed. So compared to a reinsurance company, which is the model that we're recommending is a superior model to the micro captive, a reinsurance company is structured differently in that you do not have the high capitalization rates. In our model, the capitalization rate to buy the preferred stock in the company is $50,000. The minimum and there is no minimum revenue requirement other than we generally find that about $500,000 of revenue is indicative of those businesses that are above that generally have additional cash flow that they want to shelter away somewhere or self-insure. Businesses generally under 500,000 may not be at that point of profitability yet where it really makes sense for them to do something like this versus other types of tax deferral or tax elimination strategies. There's a much lower setup cost and administrative costs. There's a $7,500 appraisal fee that brings the underwriter or the appraiser in to assess that particular business and evaluate what are all the insurable risks from including the ones that we saw previously that Craig had talked about. A lot of risks out there that a lot of business owners acknowledge that are out there, but they're not, they don't see them as significant enough to go pay for a policy where they're paying, insurance premiums to a third-party insurance company, especially if they've never had any claims in those areas. In our situation, there is no state insurance regulation. Everything is still compliant with the IRS, but at least you're not subject to the oversight and the micromanagement of a state insurance department, which also means that there's no premium taxes that are assessed. And then probably as importantly, there's no sharing of risk with other business owners. So the only risk you're insuring against is the business owner's risk that comes from their business. And the premiums the required premiums are going to be generally lower. Again, we recommend generally that if a business has at least about $50,000 of insurable risk, assuming that they have adequate cash flow, that's usually the low water mark. That a lot of the clients that we deal with where it makes sense. Above that, if they can put in more, is where this becomes very attractive. So again, just talking about some of the disadvantages of the micro captive regulated by the states. Investment options are very limited. You've got capital and surplus requirements and distributions. Anytime a dividend is paid, you generally have to get approval from the state insurance commission. You have to pay, to have an audit done, every 3 to 5 years. But they can be placed into receivership by the state's insurance department, so the client could eventually, actually lose control of their company if if they don't dot the i's and cross the t's. And then you also have the premium tax that generally is going to be imposed on every dollar of premium, in addition to those administrative costs that I talked about earlier that are in the low 30% range. So how this is going to be different, that Craig and I have put our heads together and found a unique way to create a very attractive alternative to the micro captive is we in our situation, we don't need to use trusts, which generally are what's going to be how the assets of a micro captive are managed. You're not required to have a trustee or an outside manager. There's no involvement from the state. No procedural roadblocks or hurdles that you have to get into go over, and the fees are not exorbitant. They're at least half of what the traditional micro captive costs. So that leads to what Stefan was referring to earlier as what he calls a tax unicorn, and some people don't think unicorns exist. I do think that there is one exception to that in the tax world, and that is where we've been able to combine this strategy of the reinsurance company where clients can reinsure their risks, but also combine it from an ownership standpoint with either a Roth IRA or a Roth 401k. So basically the way this looks is you've got the operating business that pays an unrelated third-party insurance company a premium. There's a 17% seeding fee that comes out to cover the costs of the insurance and to put that into a pool to cover risks above generally what the premium is if the client ever files a claim. And the 83% is then paid to the reinsurance company that we've established. So we've set this up to where it lowers the cost of compliance and allows clients to still have all the autonomy and the independence, and also only insure against their risk. So the name of the company is Alliance Reinsurance Company. It then puts that net remitted premium into individuals, industry-specific series LLCs, just for an extra layer of liability protection. The client then individually or through whoever they want to own their stock in the reinsurance company, if that's their spouse, their children, grandchildren, whoever they want to be owners in this company, we recommend that they set up a self-directed Roth 401k or Roth IRA. We prefer the Roth 401k just because of the additional flexibility that a 401k tends to offer the participant. And the reason it's self-directed is rather than a captive or a custodian that's usually housed with a financial institution like a Fidelity or Vanguard. Self-directed retirement accounts have independent custodians that aren't tied to what you invest in. So as a result of that, the flexibility to invest in private equity, companies, real estate, those type of things, you now have the ability to do that inside of the self-directed retirement plan option. And then very importantly, once that premium is earned, at the end of that policy term, that net premium is then paid out. Normally, that would be subject to capital gains rate as a taxable dividend, but in this case, that dividend is being paid to the self-directed Roth IRA or 401k, which is a non-taxed event. That money then is available for the participant to redirect into whatever they so desire from an investment standpoint. Again, private equity, real estate, a managed portfolio by their financial advisor. All of those options are now available. And if they're able to wait until 59 and a half before they need any of that money then at age 59 and a half is able to be taken out income tax free. So what this is doing is combining two incredible tax strategies that individually, either one of them, have a lot of attraction to the, to the taxpayers, clients. One is the private insurance company, just as a standalone. It's a very attractive vehicle. And then having a Roth 401k or IRA that allows clients, especially those clients that are in a high tax bracket, that could really, would benefit from having, putting money into this vehicle with tax deductible dollars versus after tax dollars. This makes it even more attractive the higher the tax bracket of a business owner, to now be able to super fund another, in a way, their Roth 401k plan, which then creates tax-free income to them or whoever their participants are in their 401k. So anyway, Stefan, did you want to make any comments on this observation wise?
Oh, actually, I go ahead and keep going because it's the next slide that I would really like to comment about. Because that's
Awesome.
really, it's going to be the tell between. And what I want to make sure you understand is this is a comparison between the 831A and the 831B and the benefits of, so think of an 831B as, yeah, there's some immediate benefit in not being taxed, but you're kicking the can down the road versus this. This is not kicking the can down the road. This is making it non-taxable. Monster difference between the two. And you're going to see that on a graph here in just a second.
Yeah, I totally agree, Stefan. So this is a good case study example, and you can plug in whatever numbers you want. So this is just to give you an example of what this looks like if a taxpayer or business owner put money away either into after tax or tax deferred. If it's tax deferred, you're really just kicking a can down the road, like Stefan mentioned. So it ends up coming out at about the same, everything else being the tax rates and the rate of returns all being the same. But compared to putting this money in the reinsurance company that is owned by the self-directed Roth 401k plan, what you can see here is everything else being the same, tax rates, investment growth, taking into account the seeding fee, the ongoing administrative costs of the reinsurance company, the appraisal cost, and then assuming that in this particular case, the client has $100,000 of insurable risks that they want to pay a premium for. In the first year, you can generally double up on that premium. So if a client has additional cash flow, they can overfund in the first year, get a $200,000 deduction in this example versus $100,000, and then in year 2 through the remainder of the time period that they fund, it'd be $100,000. I reflect this as going up a little bit just based on inflationary factors of about the contribution going up about 5% a year. But what you can see on the far right, the difference cumulatively over time, it's about a 50% increase in after-tax wealth that accrues over time in the eR3 plan versus either after-tax or tax deferred. And so this is net of all fees, this is net of all taxes. So you're about 50% farther ahead doing this type of strategy as a wealth accumulation strategy versus the typical, tax deferred, or if you decided you wanted to put after tax dollars away in an investment. So very significant numbers. Now, obviously, these results would change if you either increase the investment rate of growth or decreased it. But generally, it's going to be about a 50% differential over time. If you looked at this more in a graphical standpoint, you can see how this the spread, the difference between the two just continues to get wider and wider, and exponentially, that money that is not having to be subject to tax every year is added back in, as in creating additional investment income. So this, the longer the timeline, the bigger the difference from a dollar standpoint. So just in summary, how this is different. We have a much lower revenue threshold. Our recommendation is as a business that has about $500,000 a year, that just tends to be the the break point where we have clients that generally have a little bit more cash flow available than not, but that obviously is not a hard and fast rule. That's the lowest that we've seen out there that it requires to have is about $1.5 million. So this is much less, or this opens this door, and this is what was a major breakthrough for our CPA firm. Now about 90% of our clients, because most of our clients are high income professionals or physicians, about 90% of our clients that otherwise wouldn't have qualified now are eligible for this type of a strategy where they wouldn't have been before. So it's a massive game changer in terms of now being available to a much larger audience. The premiums are tax deductible. However, there's no state regulation, no premium tax. And then what I really like is the addition of the plug-in of the Roth 401k plan that allows this client to, or a taxpayer or a business owner to be able to accumulate wealth very rapidly, and then ultimately be able to self-manage those investments. And then at the age of 59 and a half, start being able to take out that money at, in a tax-free environment. So that is not, there is no other strategy that I'm aware of over 35 years of practice that I've ever seen that combines the, that tax deductible component on the front end and the tax-free treatment on the back end. So again, just from an overall cost perspective, the stock investment is a fixed amount, no matter what size company is involved. It's a $50,000 preferred stock investment made by the Roth 401k plan. There's a 17% seeding fee that comes out of every premium dollar that goes in. A one-time $7,500 appraisal just to get the first time, the first year appraisal and an evaluation done. There is no, even though the risks may change over time, there is no additional appraisal cost in the future unless the client has another business that they want to insure risk against. There's a flat 1% management fee that's paid quarterly in 1/4 installments over time from to basically run the insurance company. Whoever the independent custodian is of the self-directed Roth 401k plan, we use a group out of California. When I did this for the first time with a group of anesthesiologists in Las Vegas, we found a very business-friendly independent 401k custodian that's low cost that we've utilized, and so we've stuck with them in this strategy as well. The only additional cost that I'd be aware of is every year we've got to report the value of the stock and what the account that's in the self-directed account. So if the participant has gone and bought other privately owned business interests, anything that's generally not publicly traded, the custodian may require an independent appraisal to be done on those assets, just so that they can file the necessary tax returns every year for the 401k plan. The next steps to set this up. Generally, you're going to fund your 401k with at least $50,000 to buy the stock. We engage the custodian, or I'm sorry, the appraiser to do the evaluation of all the risk. They come back with their list of premiums and the associated coverages. The business owner picks and chooses which of the premiums or coverages they would like. If they want all of them, then there's they can then pay that premium in either lump sum or periodically. There is also a financing option of up to 83%. There is a finance charge that's basically tied to the IRS's short-term AFR rate that changes every month, plus an additional 4%. So if the client doesn't have the cash flow immediately, but they want the deduction, they can at least leverage the 83%. That is a 1-year loan that can be paid back as a balloon the following year. Which is what a lot of our clients did at the end of last year when we presented this strategy. So that does make it even more attractive when you add the leverage option. The premium is tax deductible, like I mentioned before, and then at the end of the year, when the policy has expired, that whatever the net premium is that's sitting in the reinsurance company that was from the premium that the business owner paid, then is then paid out as a non-taxable dividend to their Roth 401k. So those are the steps necessary to onboard and to start this strategy. Again, the sooner a client generally goes through the appraisal process, the sooner they're going to know what those numbers are, and then they can plan accordingly. Between that time and the end of the year, depending on how much they want to either pay or finance. And then, and then they get to, they'll have, that much of a premium that they can then write off on their tax return for the current year. Or if they want to double up the premium, they can deduct the 2 times amount like I showed in that case study. So let's talk about next steps. Stefan, do you want to talk about this slide?
Yeah, so the next step is just we set up an introductory call to get to know your needs and then determine what we can do to help you. And so you can use the Scantron there. You can also click that link. Yeah, it may not work for you if you click. Well, I'm not sure if it'll work. Will the link work if they click that?
I just put the
Maybe.
link in the chat, so
Okay. Yeah, so you can click that link. That'll get you into a Calendly appointment. We can determine what your needs are and how we can help you and see how this applies for you. You can also use that Scantron there as well. It gets you the same results. And we can determine what we need from you, how we get to gather the information from you, how this would apply for you, give you a kind of an analysis of what the benefits would be, ballpark idea, what the benefits from you. I mean, obviously, the higher the insurance needs are, the more you can put away, but give you more of a graphical picture of how this applies to you and how it would benefit you.
Yes, and also if anyone is interested, it's not listed here. Crystal, would you type in the chat box the website, which is Alliance RECO, so RECO.com. And on that website, you can also click a link to schedule the introductory call, or we have a fairly extensive list of frequently asked questions that you can also look at. All of the participants on this call, as well as there'll be this recording will be distributed out, to other people that weren't able to attend today, along with a copy of the slides. So you'll be able to then have access to this QRC code on that. But again, the website is alliancereco.com.
So before we go to Q&A real quick, I wanted to kind of touch on a couple of things, just because I know like David's very much like me. We as practitioners just kind of gloss over some things. And like he's talking about, financing premiums, that's a very powerful strategic planning tool. Or I'll get asked, well, that's great. I would love to get my children involved. How do I get money into their 401k Roth? And then I come back to them and say, you remember the hire your kids that I've been talking to you about for years, and you've been funding that? That's how. So like I said, we tend to, as practitioners, gloss over a lot of things because it just becomes second nature. There's kind of like certain go-tos that we all, Augusta plan, hire your kids, reinsurance, the financing of insurance. It's kind of our go-to, so you just kind of take it for granted. But I just want to highlight that. So you can create a wealth plan for your children with this product. Not only for yourself, not only for a spouse that's involved in the same company, but you can direct it down into and give a super heads up to your children.
Yeah, that's exactly right, Stefan. So, yeah, so a lot of really good tax planning ideas are out there. This, to me, percolates to the top of them, especially for those clients that are really looking for a tax strategy that they don't necessarily have to share with other employees of their business, but they can certainly share this, that with this wealth creation, with their family and loved ones.